What is going on, you guys? Dylan here. I think I'm just going to give this just a few seconds for people to kind of trickle in before I get into the bulk of the presentation. Okay, lots of things going on out there in the markets today. The title of this one is going to be risk or opportunity. So when I'm thinking about risk or opportunity, what I'm really thinking about here is that in from my view and how I look at the markets, I'm seeing a lot of um, well, for one, there's going to be a lot of risk in particular sectors, and we'll cover that today. And then there's also a lot of opportunity in a lot of stocks that haven't performed super well year to date. And I promise I'm going to do my best to not mention anything about Tesla because that there's been enough commentary about that on X and on YouTube. So I'm not going to mention any of that. By the end of this, I'm actually going to provide three different companies that I think that are going to be really great, and they are free cash flow positive or gap profitable, and they're growing at least over 20% year over year. So I'm going to throw a couple different stocks on your guys' radar from what I'm seeing from my perspective, and then also talk a little bit about the broader valuation and a lot of the sector rotation that's been going on in the financial markets. So I think that the story really begins with what we've really seen year to date. So like from my personal portfolio, because it is heavy tech, that there has been a rotation out of technology stocks, especially if they don't have anything to do with like artificial intelligence. More importantly, the data center, right? So I think that what ended up happening is that we got our Chat GPT moment, and if anyone can recall, it was about a year ago that we actually saw a heavy bid in a lot of the software stocks in the anticipation. So essentially, a lot of funds and a lot of investors front I'm doing these live, so I can never really edit this, right? They front run the anticipated acceleration in revenue growth for a lot of the software companies, more specifically like the data center, the infrastructure stocks, or like the data, so like Snowflake, right? Or like Datadog or Cloudflare, and a lot of those other companies that they thought would potentially be able to stand to benefit from a lot of the AI tailwinds that we're experiencing here today. But so far, we've really only seen that in the infrastructure stocks like SMCI, NVIDIA, and things like that. So what I'm seeing out here today is that I think that what we've begun to see is a rotation, especially in the financial markets, like in the broader context. And what I'm actually seeing is actually a broadening out in the financial markets. More importantly, like the other sectors are really catching a really strong bid, and there isn't much. So I think it's actually really a healthy market, and I think that a lot of valuations, and I know that I've gotten hit by the multiple compression, but I think that a lot of the historically bubbly stocks are actually trading at really great valuations. I don't think that there's a financial bubble in any way, shape, or form, but I do think that the markets are primed for outperformance in some areas and then underperformance in others. And that's exactly what we're going to talk about here today. And then also talk about the Fed, right? So this is actually a really big week. They're going to end up releasing the SEP, which is the Summary of Economic Projections. I think it's on Wednesday. We'll cover that, and we'll make sure we go into all the details about the expectations, about the last SEP, and really what we can expect moving forward. And a lot of additional insight about like how we expect, or at least how I'm thinking about how I could see a lot of these expectations. More importantly, the rate cut expectations and the unemployment expectations moving forward. I think that right now, like the economy on a broader perspective is a lot stronger than anticipated. We still are in an inflationary time period, and we'll talk a little bit about that too, because that was last week we had a lot of that inflation data. So we're going to talk. I mean, we got so much stuff to talk about. I might as well just get on into it, guys. I got a lot of great stuff here for you, so make sure you hang around. All right, so let's talk about valuations, right? So this is basically what I was talking about here, and what I'll do is I'll actually cover basically the forward PEs, but more specifically the forward PEs in particular companies. So as it stands here today, I think that it is something to be concerned about when the S&P 500 is trading at about 20. It's a 20.4 forward PE. But what you can actually see, and it's actually at the bottom. I'll talk about this here in just a second, but this is very concentrated, and you can see that it's very concentrated in that mega cap 8 forward PE. Where now it's actually going to be around the 2021 or late 2020 time frame. Like the valuations are extremely high right now. For me, I like as much as I want Microsoft or Apple or whatever it might end up being. For me, I just can't find the justification. I like to buy things when they're cheap or when they're a reasonable valuation, so that at least you have that margin of safety. But like you still have a lot of the small and mid cap stocks that are trading very reasonably. That I do think that there's still a lot of opportunity to be had in a lot of the profitable, growing small cap stocks. But I think that this is probably one of the most interesting things that I'm seeing in the financial markets. So what we have here is that like the forward tech or the forward PE for technology stocks are about the 2020 is close to the 2021 high, and the median forward PE is still pretty high on a historical basis. Like you got to go all the way back to the dot-com bubble to really see this kind of forward PE, but but this is very interesting all the way down here at the bottom. So, but the value portion of the markets, which is what we're actually seeing a bid in, is actually trading at a really reasonable multiple. So you're seeing, I mean, this is a pretty historic rise right here when you look at the growth stocks from just this year alone at a year to date perspective from on the S&P 500. Like this is extremely elevated, and it does concern me. And I think that it's really concentrated into one specific company, or maybe a couple. But from like a broader perspective, the S&P 500 is actually trading really reasonably. So if you just xed out growth, or sorry, xed out like tech, I mean, the S&P 500 is not in a bubble in any way, shape, or form. So this is exactly what I'm seeing here is that you can actually see the consumer staple stocks. So this is like what I really started picking up on, and because I noticed that my stocks were going down, and I was like, what the heck, like, are we going through a correction or are we going through a stabilization? Like, what are we going? What's going on? And I think that the word to really call it is a sector rotation. So consumer staples on a year-to-date basis, they're trading up at about 4.9%. And you can actually see on a 5-year basis that there's been a really nice rise over the past couple months since that October low, and it hasn't really slowed down. Same thing ended up happening with XLE, where XLE is looking like it actually wants a new high. Historically, when you start seeing energy run, this marks a major market top, and this is definitely something to pay attention to because this could lead to the inflation trade coming back. It was very painful in 2022. That was like the inflation trade, so we could see something like that. And even on a year-to-date basis, you can see that energy is outperforming, where it's at 8.89%. So once again, now we got consumer staples, which is historically like a risk-off sector, XLE, which is historically a risk-off sector. Both of those are trading up on a year-to-date basis and outperforming a lot of the tech stocks that I have. Same thing ended up happening with healthcare. Healthcare right now is actually trading up at a year-to-date basis at about 7%. So as I do these live, obviously I start to get like cotton mouth, right? So on a year-to-date basis, you got 7% for healthcare, which is another risk-off sector. So once again, going back to that narrative of broadening out this rally. And then one more, the financial sector is actually doing extremely well this year too. And you can see this. I did a 5-year chart because from that October low to now, I mean, XLF has been on an absolute tear. And on a year-to-date basis too, once again, 8.59%. So essentially what I'm seeing here is that this is actually really healthy behavior. So when you actually see a lot of the other sectors start to perform and not just the choice few stocks, like just specific technology stocks or like a lot of the software stocks that I own, for me, that gives me a lot of confidence. That gives me a lot of confidence in really two things. It gives me a lot of confidence in knowing that we're not positioned for a broader market crash, right? Because the market, you need the entire market to crash, not just a sector rotation. And I think that that's exactly what we're experiencing right now is a lot more along the lines of like a sector rotation. So even though I do anticipate volatility to enter into the markets, especially over the next couple of weeks, probably until the end of March, maybe May, or maybe even into April or something like that, I do think that because the other sectors are broadening out and because value stocks are actually catching a lot more of a bid right now, I can't see that this correction is going to last much more than maybe just pulling back to the 200-day moving average. So actually, let's talk about exactly what we're seeing here in the Nasdaq as well as the S&P 500. So the Nasdaq did stall when it hit that all-time high. So you can see that it's the weirdest thing when you actually look at a lot of these charts that they kind of bounce off. Like they always go through these areas of support and resistance. And there was definitely a lot of resistance here at this all-time high mark. And now we're actually seeing the MACD start crossing over. We're coming down from overbought conditions. This is on a weekly basis. And on a daily basis, it's even more crazy right now. Where that RSI, like we've actually have a really strong negative divergence. And you can see this right here. This historically tells us that the rally is weakening out, and even though we've been following like this 30 SMA on the weekly chart, I think this is oh, actually that's a daily. So we've been following the 30-day moving average. If we break below that, I could absolutely see us coming down, probably to the 200-day moving average, which that's a correction. It's about 10%. Like what do we got here? So it's about 14,261. I mean, yeah, that's about 10%. So if you go down about 1,500 points, I mean, that's nothing to that's a lot more of a buying opportunity. And once again, like I ended up mentioning, that I think here, let me actually show you guys what I'm looking at here. It's actually a lot more of a buying opportunity in my opinion. Just because the other sectors, I think that we're actually going to see that sector rotation, right? Because the other sectors are performing well, because value stocks are still inexpensive, where we're really starting to see like this intense narrowing of the rally. And I think that when you actually show the year to date gains in the S&P 500, it really gives that away. So like even though the Nasdaq has rallied significantly this year, you see like Apple down -10%, Tesla down 34%. And I mean, Meta's up 36%. I do think that that's justifiable. Their valuation was extremely low last year. Now I think it's actually receiving the multiple that it probably deserves. But there's one name. There's actually two names that you see there that's just glowingly obvious as to where a lot of these gains have come from, and it has come from Nvidia, which is now up 77% year to date, and AMD up 29.6% year to date, and then obviously you have Eli Lilly. But what this is basically telling me is that there's nothing here that really sticks out too much, meaning that outside of Nvidia, AMD, Meta, and Eli Lilly, and obviously Tesla, that there's really not too much that's telling me that we're in a euphoric bubble. But I do think that it's reasonable to assume that as we start transitioning into the next market cycle, I mean, like if you guys actually multiply 77% times four, what does that end up being? Like 280% is basically what Nvidia is on track for. There's going to need to be significant multiple expansion that continues to justify this type of move. And then also justify any sort of future returns that you're going to have on an entire year-to-date basis. And so, like when you even look at the Nvidia chart too, I mean, it kind of goes back, and I talked a little bit about this last week, where like a parabolic move is a parabolic move, and you just got to call it what it is. It's not that Nvidia is. I mean, I think it is overhyped, but here's the thing: like a parabolic move it's just like historically these things correct downwards. And what I'd really like to see just to maintain the health and the overall stock is actually trade down to the 200-day moving average, which I don't think is irrational or illogical. And I think that even though Nvidia has really produced a lot of, and I'm even seeing like other financial influencers talking about Nvidia and saying, yeah, this stock's going to 1,200 per share. I mean, sure, but right now it's a 2.16 trillion-dollar company. So now it's a massive company. And I think that when I actually look at the valuation, I think that a lot of the expectations have been, for the most part, priced in. So last week, this is actually, they were pricing an 88% year over year growth. Now, apparently, we're going to have 90% year over year growth, which is really confusing to me when I actually see that. So there's been a continuous upward, sorry, I meant to say, this was the EPS is 88% growth. So it's really confusing to me that they continue to revise up the expectations for Nvidia. And I think that, especially when we're talking about Nvidia specifically, is like, so the way that, so like this happened to Tesla, right? This happened to Tesla about 3 years ago. And I think that Nvidia today is a lot more like Tesla 3 years ago, where analysts kept on revising up their expectations, their growth expectations, and more importantly, the earnings expectations. And I think that it's not going to necessarily be the sales numbers that drive the overhead pressure in Nvidia. It's probably going to be a lot of the earnings estimates, because so usually what ends up happening with emerging technologies, and I actually pulled up this Gartner hype cycle. Usually what happens with the emerging technologies is that, let me explain this real quick. What the Gartner hype cycle is all about is that historically, when new technologies come into the scene, they do almost always, like especially the more exciting ones, go through some sort of hype cycle, right? So like even the work from home theme that ended up happening in 2020, the EV theme that happened in 2021, et cetera, et cetera. I mean, a lot of these actually go through some sort of hype cycle where there's a lot of like, there's peak of inflated expectations, basically saying like Gen AI is going to come in and save the world, right? that's usually a narrative that is preceded by that peak of inflated expectations, and then over time, a lot of these companies start realizing that even though that they've been investing hundreds of billions of dollars, and in some case, well, yeah, hundreds of billions in some cases, or tens of billions of dollars into a lot of this basically build out of Gen AI infrastructure. Um, Eventually, they're going to start needing to see some sort of business value from that. So right now it's like, is that going to continue? Is that sort of investment pace going to continue? And that's where a lot of my concern comes. And it's not even just that, it's that right now we have a lot of I actually got to show you guys what I'm looking at. So there's actually a lot of uh overhead pressure. I think there's also going to be a lot of overhead pressure from competition. So if you guys were paying attention to the hyperscalers earnings calls, and then also even Tesla's earnings calls, where they're actually making their own semiconductors, specifically for their own infrastructure. So I think that there's going to be a lot of indirect competition coming to NVIDIA. And then AMD is releasing the MI300X. So now AMD is looking to actually go into the market, and they're ramping right now, and they're getting their MI300X, which is, I mean, I don't think it's going to be as comparable as the H100 Gen 2. I don't know exactly what it's called off the top of my head, but I mean, still, it's going to take market share, and there's going to be new and exciting advancements. I think that they're going to be able to meet their revenue expectations, especially for this year. But I think that what we're actually going to see, I think that we're actually going to see a decline in the margin profile, much like what ended up happening to Tesla. So even though Tesla was able to grow effectively since 2021 when it hit its peak, all the way up to now, so they were still growing the revenue effectively. It was actually margin compression that ended up happening because new competition ended up coming onto the market. They had to basically lower the prices on their vehicles because there was new competition coming into the market. You know, China's economy started struggling. Same with the U.S. economy and the overall vehicle market. So that's really what I think is going to end up happening. But once again, going back to the overall point that I'm trying to make is when we look at the S&P 500. Let me pull up the chart here real quick. When we look at the S&P 500, I think that what we're actually going to see here is once it breaks this 30-day moving average, I could actually see some sort of downward move down to that 200-day moving average, which would ultimately be a very, very healthy move for the overall index. So you can see that historically, you know, even coming out of a bear market, that it usually creeps along its 200-day moving average. So we can go all the way back to 2009. You know, sometimes it does get extended from its 200-day moving average, but the sign of a healthy bull market is when it does creep along its 200-day moving average. So even like coming back into here, boom, boom, you know, like, and then it didn't touch the 200-day moving average for a couple of years. And then in 2018, we got a correction, and then we got a crash, a type of crash. It was like 21% down from peak to trough at the absolute peak to trough. And then, you know, I guess in 2021, that wasn't a very healthy bull market. But historically, when we look back, and I can even pull back the chart, even going back in the pre-2000 era, historically, seeing the S&P 500 pull back to its 200-day moving average, this essentially tells us that it's getting rid of a lot of the froth, and that's a very healthy thing for bull markets to do. And that's basically what I'm looking for here. I think that is going to happen here in the next probably in the next couple weeks, maybe even next week, maybe even the week after that, because we do have the Fed meeting coming out. I'll talk about that in just a minute. But going back to what I'm talking about here from a overall perspective, I really don't think that from a broader market perspective, going back to value stocks, software stocks have also gotten blown out, and a lot of these high growth stocks. And you can see that I think most importantly, just by this chart alone. So you can see that it traded up to it was like over 15 for basically the high growth median. And then it just got shot down over the past couple of weeks, and in a very aggressive fashion, all the way down to a median of 10x. For me, this is a very optimistic development. This tells me that there's probably going to be a lot of good forward returns for a lot of the companies that I own. And another interesting observation I made about a lot of these software stocks that are a lot of the high growth stocks, and it's so when I use the software stocks and I use like this estimate here from Jam and Bulb, I don't just look at this as like just software, because I noticed that a lot of my other growth stocks like Mercado Libre or even like Shift4, like these aren't necessarily software stocks. Well, Shift4 is a software stock, but I think that or Global E, so a lot of the e-commerce stocks, a lot of the growth stocks, they do all trade in tandem. So even like the software stocks trade with the growth stocks, and they don't really disconnect too often. So this actually gives me additional insight into what exactly is going on. um, from a like a growth market perspective. And one thing that was really interesting that I noticed in these latest earnings calls is that I think that this right here is the story of, so like with this median free cash flow margin, this right here was the story of what's going on, why a lot of these companies are decelerating in growth. So you can see that, oh my gosh, I gotta sometimes remember to drink water. I gotta remind myself. So you can actually see that what ends up happening is that they've been prioritizing profitability. Excuse me. So they've been prioritizing profitability. So when we think about this from like a CEO perspective, so like when we got to put ourselves in in the management room, we got to put our management hat on. So a lot of these CEOs and CFOs, what they try to do is they actually try to balance out growth and profitability. When they invest into sales and marketing, when they invest into basically growing their business, so a lot of the revenue that comes in, um, what they do, what a lot of management teams do, is they actually try to take a lot of their earnings and then reinvest it back into the business to continue to grow the business, to continue to grow market share. But right now we're in a different cycle. Right now there's a lot of uncertainty going on with a lot of these growth companies. So what they're doing is they're actually scaling back their revenue growth, and they're prioritizing the health of the overall company, which is the profitability of the overall company, which is why I make sure to pay attention to those free cash flow margins. And that's essentially what I think is going on. And you can actually see that. So when we go a little bit further down, you can actually see that in the, let's see, right here in the median net retention. So you can actually see the net retention go down along the lines of about the same time the median free cash flow margin went up. So this is, and then also the median year over year growth. Once again, same correlation. You start seeing the median year over year growth, which was a very, this is like the best time right here for software stocks. This is when they peaked. It was Q4 2021. And then, of course, the year over year growth started declining. And then with that decline, due to economic factors, due to higher interest rates, a lot of the companies started prioritizing that free cash flow. And when they prioritized that free cash flow, that once again acted as an additional headwind to a lot of the growth. So what I think right now is going on with a lot of software stocks and a lot of growth stocks in particular is I think that a lot of them are actually, I think that they're guiding super conservatively. So I think that right now is, if you guys have ever really eyed some of these software stocks, and I'm actually going to talk about a couple of them after I talk about the Fed here. There's about three of them that I have on my radar right now that I think is that they're all trading at just really great valuations. More importantly, like I think that they're actually at a bottom from a growth perspective. So not only are they reaching that free cash flow profitability, a lot of these companies, some of them are actually reaching gap profitability, like CrowdStrike, which is reaching gap profitability, Palantir, which is also reaching gap profitability. So like when you see this gap profitability and non-gap profitability actually starting to be emphasized, this has a tendency of like weeding out the weak companies, and then a lot of these strong companies actually end up taking over. So we're seeing that in CrowdStrike's earnings. And I covered that in my Savvy Trader, where I think that CrowdStrike is going to be a dominant platform moving forward and has a very strong potential of reaching the S&P 500. All right, let's talk a little bit about the Fed. We got a lot going on this week. So yes, it is Wednesday, which is going to be the FOMC interest rate decision. So what it's not just the interest rate decision that's going to be impactful this let me go back to sharing my screen. It's not just the interest rate decision that's going to be impactful this coming week. It's actually going to be the SEP. So the summary of economic projections from last this act just came out in December. So they do this once a quarter. From December, what they had is they had the median Fed funds target here. So they priced in basically about 3 rate cuts for 2024. I actually think that, and that was down from September's meeting. I do think that this meeting, I do think that they could actually price in only 2 rate cuts and tell us that they're not going to be as aggressive as that what they originally anticipated. I also think they're going to revise up their PCE inflation, and I think that they could potentially even revise up their unemployment. I think that this is going to be something that's going to be very important to pay attention to, their unemployment figures, because the jobs market is weakening. And that was most clear here when I took a look at Nick Timoros's post, and this wasn't last week, but as the week before. This right here was a very clear sign to me that what I'm seeing here, or what we're seeing here in the markets, is that the labor market is starting to weaken. But the problem is that the labor market is weakening at about the same time that inflation is starting to tick up. So when we look at the 3-month annualized rate of change for inflation, it actually ticked up. So 6 month and 12 months remain largely unchanged. But still, this was something that I that I've been paying attention to that's actually really concerning, especially when we're thinking about like what sort of forward projections that they could do. Because this tells me that right now we're getting very late cycle for when the Fed is about to cut rates, and more importantly, like when are we actually going to be able to break the back of inflation, right? And that's what we're really looking for here. And we didn't get that this last earning or this last CPI. What we actually got was we got something completely different, and then also we have XLE running, right? We have a lot of commodities running too. So when you actually start seeing that correlation, that we are starting to see some sort of emergence from inflation, while the unemployment is actually ticking up, I do think this is creating what could be the perfect storm for the like a perfect narrative for a market correction. Even though I think a lot of my stocks have personally bottomed, and I'll talk about that here in just a second. I think a lot of my stocks have personally bottomed, and I also think that a lot of these other sectors like XLV, so healthcare, and a lot of consumer staple stocks, XLP, I think that these are also going to experience stronger than expected growth this year. But still, it's like right now the forward. When I look at next 12 months into the future, there's a lot of uncertainty that I'm seeing here from my perspective, where it's just like, how are they actually going to be able to navigate the weakening employment data? And then how are they also going to make sure that inflation is finally broken? Because we're getting a lot of negative or a lot of hotter than expected inflation reports to where it does start to raise some red flags where we do need to start paying attention to this. And not only that, but like the yield curve is also still uninverted. So it's like, I mean, I know that it's kind of been going back and forth, and right now we're seeing a very unusual narrative where it's like, oh, the inverted yield curve doesn't matter. But let me talk just a brief moment about that. So, like, what does the inverted yield curve even mean? So we got to understand like what's the difference between the short end and the long end, right? The long end is essentially, so the long end is like, think about it as like 5 years plus. So the 5 year treasury to like the 20 year or 30 year treasury, right? That is essentially telling us what the longer term expectations for interest rates are going to be. So this says the bond market is basically telling us like this is where I think that the neutral rate is going to be. And then the short end of the spectrum, so that's going to be like the 3 month, 6 month, 1 year, and 2 year. The yeah, Fed, not the Fed funds rate, but the T bills. So that's why we use the 10 year, 2 year yield curve, because that's essentially telling us like what the Fed or what the market thinks that the Fed is going to do as far as the interest rates go. So when the yield curve uninverts, and let me go back to the yield curve chart. So when the yield curve actually uninverts, what this essentially means is that this means that the market, the bond market, smart money is telling us that they expect the Fed is going to lower rates in the very near future. And when they want to lower rates, this basically indicates to us that it's basically a response to the economic data. So the economic data that's coming in is basically saying unemployment is starting to tick up. The jobs market is starting to become structurally weak. So yes, Fed, you can go ahead and raise rates if you want to raise rates. But right now, what we're seeing here is we're seeing that this is going to create a lot of economic turbulence. And you can see that once the yield curve actually uninverts, this is, so people always think that the economy goes into recession because the yield curve uninverts. That's not true at all. The yield curve uninverts because the economy is going into recession. So the economy is the economic data is the leading indicator here compared to the yield curve, right? So the yield curve is basically just the bond market telling us, especially equity investors, because I'm an equity investor, tells us like what to expect with the economy over the next 12 months. But still, like I ended up mentioning, I do think there's a lot of opportunity right now in this market right now. And this is completely excluding Tesla because I talk about them all day, so I'm not going to talk about them here. I do think that there's a lot of great, like what I ended up seeing, especially after this latest quarter's earnings, is that a lot of software stocks, and Adobe just ended up getting basically shot, not to like after their earnings report. And it was very confusing because a lot of these software stocks are actually coming out with really good expectations. And they're trading into their major moving averages, and they're trading at like, so you can see GitLab here. So I've been buying GitLab. So right now you can see that they're about an $8.42 billion market cap. I think they have roughly about $1 billion in cash on their balance sheet, and this is just basic math. And then for their full year expectations, 735. So they're basically trading a little over 10x next 12 months EV to sales. And why I think this is a good deal is when we go back to like Jam and Balls thing here, from this is on a historical perspective. when a lot of these high growth software stocks hit that basically like 10x next 12 EV next 12 months to sales, this puts us at similar valuations to like what the historical mean is, the 2015, 2016. I wish this actually went back further, and I didn't pull up the chart thinking I was going to go that far, but this is actually very correlated with like the last 25 years of data for a lot of these. Well, let's say 20 years of data for a lot of these software stocks is when they do actually trade at that 10x next 12 months EV to sales. Then this is going to be a really good buying opportunity for a lot of the higher growth companies. So I think GitLab is actually a really good buy, especially here where it's hitting that oversold RSI. It's at that 200-day moving average, and it's also trading at this line of support right here, because resistance becomes support, support becomes resistance. Once support is broken, it becomes resistance, or once resistance is broken, now it becomes support, and that's exactly where GitLab is trading right now. So it's trading at a good valuation. They released really good earnings, and let me actually cover that real quick. They released really great earnings. I don't know why the market didn't respond positively to it at all, but like they grow 33% year over year. They are non-GAAP profitable, so they actually have a positive free cash flow margin. And their guidance was just slightly off. I think that their guidance came in from, I think the expectations was like 735, but I don't worry too much about that, especially when, excuse me, especially when the entire sector does the same thing. So when the entire sector actually produces bad, or when it guides down, from my perspective, the way I look at that is like, okay, there isn't a GitLab problem. It's probably a market problem. And that's two very different things as an investor. It's like, is it a company problem? Is it a company specific problem? Or is it an economic market problem? And I think that that's exactly what's going on with GitLab. And it was undeservedly shot, right? And now it's actually trading at that line of support. It wouldn't surprise me if we actually start seeing this sucker run here in the next couple of days, probably this week. So I think that also Snowflake is trading at a very attractive valuation. And I do think that if it gets down to like this 145 area, this 147, 145. So it looks like, I mean, this thing could bottom any day now. It could bottom today, it could bottom tomorrow. The valuation going back to that. So I didn't actually run those numbers, but we can actually pull that up right here. The valuation for Snowflake is 14x next 12 months EV to sales, but it's trading at 11.6x EV next 2025's revenue. I do think that from a Snowflake perspective, I think that they guided conservatively once again, so they don't have to guide conservatively for the rest of the year. And this is Snowflake. So they guided for about that 22% growth. And I do think that that was a very conservative guide. I think that in the event that interest rates come down and the economy and the market starts to ease a little bit more, I think that what we're going to start seeing is an acceleration, especially in the event that interest rates come down. So even though interest rates coming down, so like the Fed funds rate coming down is an indicator of a bad economy, I do think that, it's kind of like the vehicle market, like with Tesla or a lot of the home market. When interest rates come down, and tech stocks are also interest rate sensitive, when the interest rates come down, this acts as a tailwind. This incentivizes business investment. This incentivizes lending. So once the labor market breaks, then inflation is going to break at about the same time. And you can actually pull up the historical correlation here. And then I do think that that's actually going to benefit a lot of these secular growth companies that are actually, it's like, think about them in 2030. Are they going to be higher or lower? It's pretty simple for me. And I also think that Sentinel-1 got undeservedly, once again, trading just like GitLab. So you can see this previous resistance is now going to be acting as support. So you can see Sentinel-1 right here. So it traded right here at its previous resistance level, which was its recent high, its 1 year high, and then it traded down. And now I think it's actually trading at a very, very, very good price right now. I do think that Sentinel-1 is a screaming buy right now. They're trading at, so it's their $6.6 billion valuation. They have about $1 billion of cash on their balance sheet, which has their enterprise value at about 5.6. But for sales this year, they're expected to do about 817. So 2025 is because they report earnings in January. So January 2025 is when so basically this is like 1 year out, right? So this has them trading at like a 7x next 12 months EV to sales. And they're expected, let me actually pull this up here. And they're expected to reach free cash flow positive by the back half of this year. And I think that they're going to do it because I looked at their negative cash flow this year, and it seemed like it was pretty obvious that they're going to be able to easily do that, but they still want to make sure that they're taking market share and investing for growth. So I guess this is past. So we got to go to the future. We got to go to future performance here for Sentinel One. All right. I don't know exactly where it is. Anyway, that's basically what the earnings ended up saying here. I don't know why I can't find the future. This is the problem with doing live streams, right? So essentially, I think that Sentinel One is also trading at a really great valuation at the moment, especially because the management does believe that they're going to be able to hit that free cash flow positive. Uh, I'm not sure if I agree. So I got a comment here. It says GitLab's negative 15% reaction to Q4 was warranted because they postponed profitability. No, they didn't. They're free cash flow positive right now, and they're expected to be free cash flow positive for the rest of the year. So it's, I mean, there's non-GAAP and then GAAP profitability, but that has to go into like how you actually analyze a lot of the life cycle of a lot of the companies. Earlier in the life cycle, typically companies invest for growth, so they basically delay that GAAP profitability, and they'll use like non-GAAP profitability metrics. And that's a good leading indicator to what the overall health of the business is, so that it doesn't have to raise any more money. It's like self-funding. I'll share the post on Twitter. I'll share that with you guys. But I do think that there's a lot of opportunity in the markets. Let me conclude exactly what I talked about here today. I think that right now the markets are overheated because of a few different companies, and I talk about it. I think I've been talking about NVIDIA for about the past 3 weeks now, and I do think it's a major risk. I think it's a major risk because there's nothing more terrifying to me than expectations continuously getting revised upward, and expectations. Expectations, earnings, whatever it might end up being, like analyst expectations consistently getting revised upward, and a lot of positive sentiment and a very positive stock price. I mean, it's rallied almost like 80% year to date. So for me, that tells me that that's too frothy at the moment. But I do see a lot of other sectors in the stock market right now that are trading at extremely reasonable valuations, like S&P 500 X Tech, or not X Tech, X Fang. You know, like not Fang anymore. You don't call that the Mag 7, whatever you want to think about it as. The name changes all the damn time. But I think that the S&P 500 is like trading at like a 15 or a 16 forward PE, which is in line with historical norms. So if you exclude just 7 of the stocks, right now the S&P 500 is trading at a really reasonable valuation. But I do think that those 7 stocks right now are essentially what's driven a lot of the rally here in the S&P 500. So I do think that there's actually going to be a lot more of a normalization happening for the rest of the year, where it makes a lot of sense to me to see a lot of the other sectors perform very strong, and maybe even a lot of the stocks that I own. And I think that a lot of the stocks I own are going to perform very well for the rest of the year. And I'm about to release my price targets out on a lot of these companies, and I'm looking through them, and I'm like, yeah, a lot of these companies are actually really undervalued right now based on their historical means. And I also think that once interest rates come down, we're going to see a lot of positive movement in real estate stocks. So the XLRE is the sector that I'm thinking of here. I think that there's going to be a lot of positive movement in a lot of the tech stocks, the vehicle sector too, because these are historically interest rate sectors. Solar as well. I think that this is exactly where the opportunities are at in the market right now before the next major market rotation happens. I don't see a market crash happening, even in the event that unemployment starts rising. If the Fed is able to control the credit crunch, so any sort of credit crisis, like what ended up happening with Silicon Valley Bank, if they control that, and they will, so if they control that, then all I can really see here is about a 10% correction end up happening back to the 200-day moving average, which would put us at a very reasonable level. And then I also think the S&P 500 is going to have a really good year this year. So I think that everything is very optimistic. Everything is very positive, but I do think that there's risk in the market. And I think this has been a very market that's been driven by a lot of momentum. And I think that right now is actually a really good time to buy specific companies that are still growing, that are free cash flow positive, not even just them, but there's also like Shift4 is also trading at a really good valuation right now. And the stock's probably going to get hit on Monday because they ended up saying that they're not going to go through with an acquisition. So I'm sure that the stock's going to sell down. But right now, when I look long term at this company, I mean, they're doing the right things, and they're also growing their earnings effectively, and their revenue, and their free cash flow. So like that's exactly what I want to see in a lot of these companies. I think that longer term, like right now, there's been a lot of short term headwinds, and that's okay. That happens. Sector rotation is a very real thing, and I do think that looking forward, it's very optimistic and it's very rosy from here today in certain companies and in certain sectors. That's all I got for you guys this week. Until next time, you stay classy. Oh, got to end the live stream. Still figuring this out.